We just talked about international investment with cover, which means that you sell the proceeds of your foreign investments in the forward market in order to avoid exchange rate risk. But what if you like to live dangerously? In that case, you might engage in international investment without cover. And so rather like speculating, which is what this is like, you're going to have to form an expectation about the future exchange rate. Because when the time comes, you're going to have to take the proceeds of your investment and turn it back into your home currency. The future spot rate, I should say. Okay, so let's say we've got IUS is equal to 3%, and IUK is equal to 5%. They're nothing like that big, of course. Is that good? I mean, if you're thinking about investing in British bonds instead of American bonds, is that good? Depends on what you think is going to happen to the price of the pound in between now and then. And so the expected meaning that you formed an expectation, you haven't covered anything. For example, the expected uncovered interest differential which is usually abbreviated as EUD, expected uncovered interest differential EUD will be equal to the expected appreciation, that which you believe, the expected appreciation of the pound, if you're American putting money into the UK, expected appreciation of the pound plus the interest differential IUK minus IUS. So in this case we have IUK is 5%, so we'll leave this for a bit, but we've got 5% minus 3%. So depending on what you think is going to happen to the pound, that's either good or bad. Let's say you believe that the pound is going to fall by 2%. Okay? So if you have this belief, then essentially the 5% interest, the extra interest, is merely compensating you for the fact that the currency, the pound, is going to depreciate during the time period that you have the have the British pound denominated bonds. So we have -2 plus 5% minus 3, so this would be 0. This would be considered uncovered interest parity. Which is when the forward premium or discount on the foreign currency is just enough to compensate investors for any differential in the interest rates. And so what's interesting about this is that interest rate differentials contain beliefs about the future direction of exchange rates. Interest rate differentials on comparable assets, usually like a 3-month treasury bill or something. Interest rate differentials contain information. So if you go to Bloomberg or somewhere else and you find that a German bond pays 1% and a British bond pays 3%, then the market's best guess is that the British pound will depreciate maybe 2% against the euro. I know the Germans are all mixed up with other countries, so maybe that's not the best example. So the interest rate differentials contain information about market beliefs about the future directions of currency exchange rates. So if you see a country with high interest rates and maybe you're tempted to put all your money in Greece or something, Well, there's two things going on there. The first is that possibly they'll quit the euro and then they'll reintroduce the drachma and then their currency will fall, or maybe they'll just default. So the currency risk makes that a bit complicated. But if you see two countries with comparable degrees of country risk, and you see that one country has high interest rates and the other has low interest rates, you can pretty much assume that most people think that the high interest rate currency is going to be experiencing, country is going to experience a depreciating currency over the lifetime of the bonds. So empirical support for this is a little more difficult, because apart from anything else, how do we know what's inside people's minds, what they expect of exchange rates? But certainly it is a theory that can be quite useful in linking all these different markets and explaining, anticipating what markets think is going to happen next.